Well, we hope you had a good Thanksgiving. And I guess now it is on to the next holiday. It seems like the next one is sort of overshadowing the last one. We had to kind of really find some space to put the blow up turkey at the office because everybody else was putting out Christmas decorations. Certainly, I guess the next season, the holiday season, is one that all Americans love, right? Yay, consumerism. There you go. Joining me on the show this week, once again, is Rob Field. Good morning. How are you?
Joel, doing well. We are, 5 weeks away from Christmas now?
Holy mackerel. Yes, we are racing to the end of the year. That is for sure. Hard to believe 2023 is going to be in the books soon enough. And on to 2024, which is going to be a year of distinction, particularly around here at Nelson Financial Planning, right?
That is true.
Our 40th anniversary as a business. So we are excited to talk more about that and what we have in store for our 40th anniversary coming up in 2024. So, Rob, I asked you to join me on the program this week, sort of a continuation of our conversation last week when you joined me on the radio show here on Dollars and Cents. Sort of a topic that we are going to hear more and more about because fundamentally, statistics don't lie, surveys don't lie, and the reality is that the core of this conversation is really about the quality of one's retirement. I think that sort of gets lost in sort of the fixation on the numbers, but more and more you're hearing that retirees are somewhat unsatisfied. It doesn't really have to do anything with the money part of it. It really has to do more with some of those concepts that we talked about last time involving social and health and legacy. And certainly there's a lot to be said for all of those topics that should go hand in hand with planning one's retirement.
Right. We talked last week about a variety of things, and you mentioned that one study that showed that of all these lists of concerns retirees had, near the bottom was the financial side.
Right.
They were more worried about, not how am I going to spend my money, but how am I going to spend my time?
Correct. And the loss of routine, the loss of identity, all of those things that come into play that I don't think people really think about much when it comes to retirement. I love to ask the question when somebody talks about retirement or comes into the office and we start thinking about retirement or planning for retirement. And I love to ask the question, well, what are you going to do with the rest of your life? I mean, that's a big part of it. That's almost becomes the first question I ask beyond digging in to the finance. Because you got to have a game plan. It's not enough to just retire, but if you're miserable in retirement, well, then I guess probably just stay working. If you might as well be miserable and make money.
Sure.
But certainly there's a lot of folks that are saying, okay, what about my identity? What about my routine? Last week we covered sort of the first two pieces of that three-part conversation, kind of the social and the health issue. And Rob, I think you had a good recommendation to our listeners on the social side, sort of that 5 and 5 exercise. Why don't you tell us, recap a little bit for our listening audience what that was?
Right. A lot of times you'll ask the clients, what does retirement look like to you? And then we get them to start talking about what they're currently doing, what would they like to do down the road. And so the exercise we kind of talked on or touched on briefly was kind of what we call that 5 and 5 exercise, where you're going to list 5 things that are very important to you, very meaningful, that you certainly want to do and focus on during retirement. But at the same time, you make a list of 5 things you find less meaningful, that don't really give you as much pleasure, that you might be involved with right now. The thought is, okay, let's weed out a couple of the items that are not meaningful to you, give you more time to do the things that are meaningful, so that as you're moving forward, you're doing things that are making you happy in retirement.
Well, then that's a great exercise to do. Another part of that exercise is really thinking about the year and kind of planning out the year. I think when we're working, there's a certain flow to our jobs during the course of a year that we get used to or we get accustomed to in retirement, you've got to sort of figure out what that's going to be. So another good exercise is to sort of plot out sort of a year in, not necessarily a year in review, but a year in potential in terms of figuring out what's going to happen from month to month during the course of the year. And then to take that down one more step and to sort of plan out what a week in retirement might look like. Certainly, a lot of studies would conclude if you do some of these exercises that we're talking about, then at the end of the day, you're going to be more satisfied in retirement and certainly not feel isolated and like you've lost control. Similarly, on the health side, right? You got to be healthy. If you're going to spend a number of years in retirement, you probably want those to be quality health years as well. Right, Rob?
Right, exactly, because you can, the finance side does come in, and we're obviously there to help get, as you make your budget and your goals, come up with the number that allow you to do the kind of retirement that you want. But if your health is not very strong, if you suddenly have saved your money, worked hard, you're at a point now where you can now enjoy it, but then you can't really get out or you can't move as much or go see the people you want, you've sort of shot yourself in the foot on the ability to utilize the savings that you put so much time and effort into.
Well, and certainly the notion of eating right and exercising. Although this past week with Thanksgiving, that was probably harder than normal for most people to do. But certainly remembering those fundamental healthy habits is obviously so important. So we're going to shift to that next part of the conversation here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We, of course, are one of Central Florida's longest running radio programs, coming to you on a host of podcast channels as well. So make sure you subscribe to us on your favorite platform. Any trouble finding us, go ahead and go to our website, Nelson Financial Planning, where we've got a bunch of icons. Click on them, and they will get you immediately connected to our stations or our channels on those various platforms, including YouTube as well. Once there, make sure you subscribe, and then that way you'll get automatically notified when we do upload new content. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Joining with me this week is Rob Field, one of our certified financial fiduciaries at Nelson Financial Planning, who also happens to be a National Social Security advisor as well. So shifting gears to that sort of that third leg, if you will, or the third concept of things that you need to think about beyond the financial side, and that is this notion of a legacy. What do you want to do with this money that you have accumulated? What does it mean to you? Do you want to help people now? Do you want to help people later? How does all of that work out? And certainly that's the other piece to be talking about, Rob.
Right, that's one of the three things that we're talking about that are non-financial related, but are very important and can be rewarding depending on how you address it. So your legacy is going to be, how will you be remembered years from now, or even currently in retirement? And that's where you start to think about, what do I want to do with my life and with my finances as I go into retirement? How do I want to share it either with family and friends? Do I want to look at some charities? Would I like to give away money now while I'm still alive and healthy and can watch people utilize the money that I've contributed? Or do I want to set up something that will live beyond me? And as I pass and the years go by, there'll still be a legacy in place, some kind of a foundation or a charity that I have given to. And so you kind of just want to think about what's important to you. How do you want those finances to progress as time goes on?
Well, that's certainly the case, and I think it comes back to just sitting down and making a list of those 5 things that, we talked about making a list of those 5 things that are most meaningful to you and the 5 things that are least meaningful to you. In this case, you want to sit down and create a list of the 5 things that are most important to what you want to leave behind. And we're going to talk more about this concept, but we got to take a break first, so we'll take a break and continue after these messages here on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning. So, Rob, have you started your holiday shopping? Looks like a lot of Americans went out there Black Friday, and then of course Cyber Monday coming up. Did you get any shopping done?
I did. You know, we had Thanksgiving, got my leftovers, and then I was always thinking I'm going to hold off on shopping. It's got to be crazy, but you get sucked in the flow.
That is true. All the deals that pop up. I mean, my goodness, they're all over the place. You know, we're very fortunate, right? Because we're employed, make a good living. And certainly we have the resources to be able to go out and holiday shop. But a lot of folks, particularly here in Central Florida, don't, which is why at Nelson Financial Planning every year we recognize that and we do an annual toy and food drive. And I know, Rob, you guys you and Christina and Jamie did a neat little post on our Facebook page here a couple of weeks ago announcing that food drive. Why don't you tell us a little bit about that?
Right. So I mean, if you see the post on Facebook, they're kind of funny. One we're kind of hiding from each other. Another one we're arguing over toys, and we're just trying to bring kind of a lightheartedness to the fact that we are doing two different drives. One is to get some toys to help underprivileged kids, and also to get some food to help people that might not have access to as much food. So during my shopping over the weekend, I mean, I started getting some things that I wanted to decorate my house and that I'm going to possibly give out as gifts. But we did stop and pick up some toys and donated to the box. I like to lean towards the sports size, so I threw in a football.
I saw some fishing poles in the box.
Yes, we had a client bring us some fishing poles.
So yeah, I was thinking, man, I could use this fishing pole. Yeah, that kind of defeats the purpose. But anyway, right. The two organizations obviously that we're supporting, Toys for Tots in terms of the toy drive, Second Harvest Food Bank in terms of the food drive. To participate, you don't need to be a client of Nelson Financial Planning. We are open door for anybody who would like to participate in either of these toy or food drives. Just simply drop off new toys, new gifts, non-perishable food items, obviously, as well, and we'll be happy to make sure that they get into the hands of those valuable organizations, Toys for Tots and Second Harvest Food Bank. So we were talking a little bit before the break about that notion of legacy. What's important to you? Sitting down and creating a list of the things that are most important to you that ultimately define your legacy. And the studies show, Rob, that if you do that, then you're going to have a better quality of retirement and certainly a more satisfactory one if you've sort of thought about these issues and really kind of sat down and mapped them out. And I guess it comes down to kind of the who, the what, and sort of the how, if you will, on this notion of legacy planning.
That's correct. You kind of want to decide, who do I want to help? How do I want this money to be used that I'll feel good about as well as will help somebody? And then where do I want to contribute? Where am I going to send that money to? And then how do I want to allocate it? And how much goes towards charity? How much goes towards a foundation? How much maybe goes toward your own family members? You just want to think in terms of how you want that distribution line to look.
Well, and certainly in today's world, and Rob, you've been in this business a while as well, there's a lot more options that you can do to make these charitable contributions. And even if you don't necessarily have a particular charity in mind right now, let's say you just want to set aside some money for charity that you might give at a later basis. Donor advised funds are a great option for that, where you make the contribution, you get the charitable deduction now, and then that money is held in that donor advised fund. And then at some later date, you can wind up then just making a contribution to a particular charity at that later date. So that's one of the ones that is kind of more unique, or I guess newer, that makes it easier to do that in the case of where you might not have a specific charity in mind right then. Similarly, and we've talked a lot about this certainly in prior programs, that qualified charitable distribution, that's a big deal.
Right, because your required minimum distribution, when it comes out of your IRA, normally that's just a taxable event. So if you step back and think, well, I am going to be donating to a charity anyway. I've been giving money to certain groups. I'd like to do it in a more efficient way. The qualified charitable distribution takes your R&D, funnels it to a true charity. That's a non-taxable event.
Right. No, and it winds up being directly offsetting that amount of the distribution that would have come out of the IRA. So you got to be 70.5 to be able to take advantage of that. That's the caveat there. Not the same as your required minimum distribution age of 73, but you have to at least be 70.5 in order to take advantage of that. And the other thing that we're seeing as well is folks that are reflecting, and maybe they've had investment accounts for a while, and over time there's certainly been some profit in there. I'm thinking of the folks that longtime clients that came in week before last to kind of sit down and looking at the accounts, and they're fortunate they've got pensions and Social Security, so they don't necessarily have to rely on the investment accounts that much, but they've got 3 kids, and a couple of them are struggling, and so we got engaged in this conversation about, well, what could we do now? We want to help them now, and maybe use the profit now rather than wait until you die in order to help them out. So those are the kinds of conversations, Rob, that I think we see on a pretty regular basis, or a much more regular basis than we used to these days.
True. We're giving to family is very rewarding.
Right.
And I know you sometimes say, what did you always say about kids are not charities, but certainly it's an area that you want to be as helpful as you can. So I think that's wonderful that they're doing that.
Well, and I think we see that more and more as people, which goes to this whole all these studies and surveys and data that's coming out now about what retirement really looks like from a quality of life perspective. And in this case, they had a couple of kids that were struggling, and obviously they had more kids, but kind of did the same for each one of them. And I think that's important to always do, to sort of treat everybody equally as best as possible. And so this was certainly something that they wanted to do. Not able to get a tax deduction for it, but at the end of the day, still able to think about ways to use their money now and who they wanted to help, their kids, and the one question was, well, we might as well do it now. Certainly there were some parts of their portfolio that had performed pretty well over time, and in particular this year. So we're able to kind of use that profit to kind of make all of that happen. Now, there's a number of things for folks to be aware of when we think about transferring money or gifting money to a loved one. And I guess the first one is that annual gift exclusion.
Right. There's the annual gift exclusion, where it's different from the lifetime exemption. So right now in 2023, you can give $17,000 per year to numerous individuals, and it doesn't create a tax issue for you. It's not impacted by the gift tax or state tax. 2024, that amount will go up to $18,000. So you could give $18,000 to numerous people without creating that tax ramification. Husband and a wife could do up to $36,000.
Sure.
They could each give $36,000 to a number of people. So it's a way to move the money now. And you obviously get to see how people use it and help them.
Right, and no real tax implications. I mean, again, I'll put some caveat there, but at the end of the day, not a tax implication for the recipient, not a tax implication for the giver. Of course, that sort of depends on, where the money is coming from. Right. But certainly that's one option that people can take advantage. I think all too often people think, oh, I've got some tax implications or some reporting implications, those kinds of things, that if I give money, I have to do A, B, and C. The reality, it's probably, much easier than that. That's for sure.
Right. And even if you want to give larger amounts, there is the lifetime exemption from gift and estate tax. So an individual can transfer, I guess this year it's 12.9 million right now is the number they base. So you can kind of think in terms of, if I do a little larger amount than what the annual does, I'm still staying under the 12.9. That number goes up to, what is that? It's going up to 13.6 in 2024, but in 2025,
right,
the numbers change dramatically.
Well, once you get through 2025, 2026, then all of those tax cuts that were passed a few years ago all wind up expiring. So you've got a very different type of scenario there. So we're going to take a break. We could return. We're going to continue this conversation of some of the ways in which you can sort of gift money now, particularly, obviously, given that it is that season of the year when people think about doing that around the holidays. So we've got some additional thoughts on that concept coming up next year on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning. Sherry at Nelson Financial Planning, where we've got a great team of people. We talk about them a lot on the program. They also join me as well from time to time. So joining me on this week's show is Rob Field, a fellow certified financial fiduciary and National Social Security advisor. Rob, we got a lively conversation going on here about some of those things that people need to be thinking about that impact the quality of their retirement.
Right. We know the investment part is important. We talked about how you need to socialize. We talked about how you need to stay healthy. But we also wanted to talk about how you get to enjoy the money that you've saved for retirement and how you get to share it with other people.
Certainly that's important. We talked a little bit about, sort of that gift exclusion before the break. But there's some other things that you can do for your loved ones as well. And one of the options has to deal with college education and helping to prepare for paying for that high expense of college. Right, Rob?
Right. You're talking about the 529 plan,
right.
Which, it's kind of a tax-deferred way to pay for your future education expenses. Kind of follows the same gift exclusion rules, but the money that goes in, it comes out tax-free as long as it's used for educational purposes. What's nice is as it expands on, if you set it up for one child and that child does not go off to college, you could shift it over to another child. If you still are sitting on some money in a 529, you could shift it down to a grandchild. And then now, next year, 2024, you could actually convert it over into a Roth?
Correct. The remaining balance. Yep. Nope. That is true. That is going to be new for next year, 2024. And that's a great point about the 529s is that what makes them unique is that there are other educational savings vehicles that sort of require the money to get used by the time the beneficiary is 30.
Right.
And that's not the case in a 529. You can change the beneficiaries, you can leave it alone, or you can even now, starting next year, convert it to a Roth. Another thing that we hear folks talking a lot about when we think about this legacy component of thinking about retirement is all about is the notion of doing some Roth conversions. And I think we're hearing more and more about that because that becomes a real option that people are considering when looking at their retirement accounts.
Right. So you've got your traditional IRA. It's been completely tax deferred. At some point when you pull that money out, it's going to be taxable. So doing a little bit of preparation, you might think, let me pay a little of those taxes now instead of later on. So convert part, or as much as you and your accountant would agree upon, convert that over to the Roth, take care of some of the tax issues now, put it off. You don't have to really worry about it as much, or it won't be as big of an issue later on.
Certainly an interesting concept for the next couple of years when you have much lower tax brackets, 12%, 22% tax bracket. Those are all going away in 2026 because those lower rates all wind up sunsetting as well. And I think the other issue, when we start to hear a little bit more about the conversion conversation, is that the rules on inheriting a retirement account have certainly changed a lot over the course of just the past few years. So if you're inheriting a retirement account after January 1 of 2020, then you've got a pretty tight timetable in which you've got to take all of that money out.
Right. Years past, before that rule changed, if I had an IRA and then I passed away, person inherits it, they keep it. They might have to take out a little money every so often, but nothing dramatic. It's now said not only do you got to take out a required minimum, you got to basically liquidate the account completely in a 10-year period. So if you're leaving a large sum of money to somebody in an IRA, which is going to be taxable, once they receive it, they got to get it out in 10 years. That's a lot of income that's taxable coming to them in a short period of time.
That is very true. And so that's one of those things where the more things change, the more it requires a little bit of thinking and a lot of planning to try and make sure that your legacy winds up being the one that you want, and most importantly, in the most tax efficient manner. And then the other thought when we think about legacy and who to leave things to, let's not forget there is an exercise that you probably want to be doing every couple of years, if not more often than that.
Right. You're referring to kind of keep an eye on the beneficiaries listed on an account. The great thing about having beneficiaries on your account is there's no argument about how that money is going to flow. But as times change, your family grows, people come, people go, you want to change percentages, you want to always review the beneficiaries listed and just make sure that if something happens, it's specified who gets what percentage or what charity gets a percentage. The family identity changes, you might want to make sure that you still got it lined up. So, and it's a pretty easy process. Just give us a call. We tell you what you got, we discuss what it is, and we can rearrange them. You should review that at least, I'd say twice a year, but at least once a year.
No, absolutely, absolutely. So that kind of covers that social, the health, and the legacy components. I guess we would be remiss if we didn't spend a little time talking about the financial aspect of a retirement as well. That is certainly important, and fundamentally it starts with budget, right, Rob? I mean, you and Christina did a great show this past summer talking about that concept. To refresh our listening audience a little bit their memory as to the gist of that show, if you will.
Right. Back in June, Christina and I did a show. And again, we've been continuing to do these type of shows that aren't just specifically the financial side of investing and in retirement. You got to kind of think in terms of some of the other subjects that we brought up. So we took the word budgets, we made it into an acronym and just basically said each letter has a special meaning. So we said B is for balance, and what we were thinking was balancing your income that you think you're going to get versus the expenses you might be perceiving. We did U for understanding, kind of understanding what is your current situation, and then also have an understanding of what's your investment knowledge. D would be for debt, your short-term debt, your long-term debt. Make sure we're managing that correctly. G was for goals. What are your short-term goals? What are your long-term goals? Make sure they're going to play with each other well. Expectations was the letter E. So what are you expecting from your investments as far as performance? And expectations, how about longevity? That comes into play. Making a decision of how you're going to address something will be based on how long you think you're going to be walking the face of the earth. So we talk a lot about longevity. We said T was for transition. We've done various shows, and we're talking about it again today, transitioning from work to retirement. It's not just an overnight step. You got to really plan ahead, think about all the moving parts. And then we said S was for solutions. So now you know you've got some issues you want to address. What are the solutions? What are your investing options? How about your budget? Review. Sit down with your financial advisor and make sure that everything is in line.
I'll tell you the budget thing, and people think, oh, I'm going to get to retirement, and I won't need to budget. But it's important there because some things there's a variety of things where you may miss them as part of your expenses. And we talk about this all the time when it comes to healthcare, right? That you're going to have to pay for that out of pocket and account for that. When it comes to taxes, well, you typically have those taken out of the paycheck, so you don't necessarily have to account for that, but you do in retirement. And then lastly is, of course, my favorite, which is the free time expense.
Right. If you work long hours every day, then the weekend comes along. Sometimes you just want the weekend to get caught up and refresh your body and mind. If you're in retirement, you don't have to work all day long. So now you're got some free time, and now it could be fishing and I'm going to buy a boat, or no, I want to buy a large boat and spend weekends on it, or no, I want an RV and I'm going to travel, or the list goes on and on and on. The more time you have, the more items you can buy to kind of fulfill that time.
That free time expense, that's another little budget item as well. And that was one of the things in the book, Next Gen Dollars and Cents, that we thought was important. So if you're familiar with our book, and if not, then we're obviously continuing to offer complimentary copies of the book. Just reach out to us through our website, Nelson Financial Planning, and request your complimentary copy. You got to do it before December 31, okay? Otherwise, you wind up going to Amazon, paying those guys $14.99. The reality is that in the book, there's a variety of tools, one of which allows you to create your own budget, where you can scan the QR code, download the budget, and then save that on your own computer. We're going to take a break and continue the conversation here on Dollars and Cents after these messages. So talking about the financial aspect of retirement in that last segment, and of course, Rob, as we discussed, it sort of starts with budget and the importance of understanding what that money coming in and that money going out looks like.
Right. I mean, we were emphasizing the importance of that because as you go into retirement, the income coming in, the money going out, the expenses are totally different. So you've got to kind of, from day one, have an understanding of what's reasonable and what's not.
No, that's exactly right. And then after that, once you kind of figure out the budget, well, then it shifts to a net worth and what you own versus what you owe. We actually had someone in the office just this past week who had read our book, Next Gen Dollars and Cents, and they had scanned the QR code and they had used the net worth template that we had as part of the book, and had filled it out, and we're saving it like we encourage them to do in the book, so that every year they can use that as a tool to update and hopefully continue to track sort of where they are in terms of that overall financial picture. Again, if you're interested in getting your complimentary copy of our new book, Next Gen Dollars and Cents, just reach out to us on our website at Nelson Financial Planning, or you can call the office at 407-629-6477, and we will put in the mail, absolutely free of charge, a hard copy of our new book. We're hoping that people enjoy it, or some of the reviews, some of the folks that have read the whole book, because it just came out here about a month ago, have really given us some very positive feedback, of which we certainly appreciate. And but use it as a tool, as a gift for your loved ones, to help encourage them to develop those good financial habits to achieve financial success. The free offer available until the end of the year, so we encourage you to take advantage of that. And then once you've done that sort of net worth exercise, Rob, right, it's important to kind of figure out, well, okay, well, what's the nature of these assets that I have in the first place?
Right. The tax nature comes into place, because how the money comes out, when it comes out, what time do you look at conversions, things like that. The tax part will have an effect on your budget. So it's a conversation you're going to want to have with your financial advisor.
Well, and certainly to really think about, and that's one of the biggest reasons why we at Nelson Financial Planning have a tax department as a part of the firm. We've got Kristen, who's a CPA, Christina, who's an IRS enrolled agent. I mean, that's why we do that, because we think it's so important to make sure that these decisions involving your retirement income properly reflect your overall tax picture, because that's where the money's coming from, right? Investments is where a large part of that retirement income comes from. You may have a pension, although those are kind of dwindling in terms of the number of people that have them. But the other option is, in terms of income, is of course Social Security, Rob, and that's certainly your expertise as a National Social Security advisor. What's the update? Speaking of Social Security, where are we on kind of the numbers, and what can people expect for those January Social Security checks?
Sure, we'll share some numbers and some of the changes. It's always important to us. We like to coordinate your Social Security options with your investment options, with your tax concerns, with your budget. It all comes around, and it's just one of those areas that Social Security is not as complicated as people think, but you do have a lot of options, so you do want to do a little bit of research. So I do encourage our listeners, clients, and prospects to, if you haven't gone to Social Security's website, ssa.gov, and just get your statement. Your statement will show you estimates of what you might receive per month. It'll show you your options as a spousal benefit or benefit on your own. So you always want to start there. And then if you get that and you have questions on it, let me know. But that statement also changes every year, because we are fortunate for most years. Social Security will give you a cost of living adjustment. So they're basically looking at what's been going on the last year. Inflation is always going to be in place. And so then they try to adjust the amount of money that retirees are getting to keep up with the cost of living changes. So we know in 2024, you're going to get a 3.2% increase in the amount of your benefit. And what's nice is, if you're currently on Social Security, you'll get that 3.2% increase. If you haven't started yet, your estimated benefits will go up by that same amount. So even estimated benefits are keeping up with inflation. Now, we can argue that seniors
really keep up with inflation.
Especially on the senior side, their medical expenses and housing expenses and transportation is typically higher than but that's a whole different story.
That is certainly the goal, is to adjust for inflation. So 3.2 for 2024.
Right.
But the past couple of years have been a little bit more.
2023, we were up 8.7. They were trying to kind of get us caught up. 2022, cost of living adjustment was 5.9. Over the last 3 years, that's a 17.8 increase percent-wise in the amount of benefits that people are getting through Social Security. So I would say they're giving it a yeoman's try to keep up with inflation, but you could argue that it's maybe not quite the same.
Well, and then that goes into the financial shape of the program itself and how all that works. But the good news is that if you're collecting Social Security, then you're going to get another little pay increase, not as much as what you got this past year, but certainly cumulatively the past 3 years have at least started to address the inflationary impacts that we see every time we walk into the grocery store. That's for sure.
Correct. We were talking about how you kind of fund Social Security. Social Security has two different buckets per se. One is they do have a large trust fund that has trillions of dollars. It used to be $3, now it's down into the mid twos. When COVID hit, a lot of people retired faster than they anticipated. Number of new workers, not as much, so they had to pay out a little bit more. But in the flip side, they also tax people that are working and earnings tax, and that helps to fund future benefits. They cap it at a certain number. It's going up. Right now it's going to be $168,600 next year. So if you were making more than that number, you will see a slight amount of increase in the amount of taxes you pay. If you were making less than that, you won't be paying any more. You won't really notice it. But that's one way that Social Security is trying to help out, is they're taxing people for future benefits.
Sure.
That
have to offset what they're paying out.
Correct.
And so
that
by taxing
17.8%.
Right,
I mean, we got to fund this somewhere or another.
Significant little jump in terms of the number, and every year that wage base goes up because that's a big part of the money that comes in to help fund Social Security.
Correct. And I know that jump is about 5.2% going into 2024. Last year, they bumped that wage base up 9%. So, we have seen an increase of, over 14% the last 2 years. So, it's kind of a moving target, right? We're going to try to do a cost of living adjustment so that more people can get a better benefit from Social Security, but we got to fund it. So now we got to go back and tax, and it just goes back and forth.
Because that wage base basically determines the amount of income up to that limit number. So you're saying for next year it's $168,600.
Right.
So up to that number, that's when you have to pay the Social Security tax, which is 6.2%. Once you get past that number, then you no longer are required to pay that. But as you point out, just a couple of years ago, that number only went up to probably $146,000. Now it's up to $168,000. So more wages are now applicable to that particular tax.
Right. I mean, Social Security's planning ahead. They know that there are people who are, I'll be retiring sooner than my kids. So my kids need to have some kind of Social Security in place. So they're planning ahead by keeping that trust fund invested, by bringing in more money, by taxing people. It's just a never moving target that we're always going to have to work with.
Certainly something to be thinking about, particularly when we think about your finances and one of the big pieces of income that you're going to get during the course of your retirement. So, well, that's about it for this week's program. We're going to wrap it on up and get on out of here. We certainly appreciate you, our listening audience. If at any point in time you have any questions about anything that we talked about on the program, or you'd like to connect to us to talk more about your personal situation, just visit our website, nelsonfinancialplanning.com, or give the office a call at 407-629-6477. Enjoy the rest of your week. We'll be back next week here on Dollars and Cents with Joel Garris of Nelson Financial Planning.